Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today. This week is one of my favorite weeks because I get to start my morning with a very nice cup of coffee and banks earnings. So today we are going to look at BMO's earnings and ScotiaBank. Both banks have actually beat revenue and beat earnings per share expectations. So solid beat for both of them. Very strong quarter. So let's take a deep dive into those two. And on Thursday on the YouTube channel, you're going to have the whole recap plus EQ Bank plus Go Easy. So the entire banking industry will be fully reviewed. Plus, I do have also another surprise for the podcast listener as well on Thursday morning. All right, so let's get started with BMO. Solid quarter, revenue up 10%, earnings per share up 22%. So we're going to have to find a difference why revenue is only up 10% versus 22 for earnings. We're going to find that in a second. So first, net income by segment. This is the way I like to look at Canadian banks, is to understand where the money is coming from by looking at net income in their different segment. So the first one, Canadian business, we're talking about personal and commercial banking, down 5%. So the story here is revenue was up 6%, but higher PCLs, higher expenses, and then boom, you're back down to -5. On the US side, completely different story. We have the personal and commercial up 42%. Kind of crazy, right? But in reality, when you dig a little bit deeper, and this is why it's so important to dig into the numbers to understand the dynamic behind it, revenue in the US was only up 3%. So where's that big net income coming from? Well, lower PCLs, and we're going to get there in a second. But this is, again, a big story for banks in general. You know, I've told you that before, but they kind of play that game, like not playing like, oh, they're crooked and they're just like giving us false numbers. That's not the case. But what happens is they tend to be very conservative, which is a good thing. This is why we love our Canadian banks. We don't want to be cowboy banks, actually. We want to have conservative banks. But by being conservative, a year later, you also have to say, yeah, you know what? That whole provision for credit losses, some of them actually are still paying, so we have to take them off that provision, which boosts earnings. And this is exactly what happened on the US side. Was not doing very well last year. This year, a lot better. On the wealth management side, it's up 21% on higher revenue on global markets and net sales. The name of the game for wealth management is assets under management. When the stock market goes well, investors invest more, assets under management goes higher, and then therefore you're charging a fee on that. So boom, you're up 21%. Capital markets has been a volatile segment for Canadian banks because depending, again, on the stock market, on corporate banking, sometimes it's going well, sometimes not so much. In this case, the capital markets for BMO was up 12%. So far, so good. All segments contributed to stronger revenue and stronger earnings. Of course, the biggest driver right now was the US side with the drop in the PCLs and wealth management up 21%. Now, let's take a look at the PCL for a second. Well, last year, it was at 906 million. Yeah, quite a chunk, right? And this year, it's down to 797. So down a little bit more than 100 million year over year. And this is what drove the earnings per share a lot higher than the revenue. So just like accounting principles. So last year you had a bad year. This year you have a better one. But in the end, it's all the same cash. After purchasing 15.7 million shares, almost 16 million, BMO has terminated its buyback program that enabled the bank to buy up to 30 million. When you look at the stock price right now, it's skyrocketing. I can't understand why management says, you know what? We're going to slow down the buyback. We're going to take a pause here. We're going to see what's going to happen. Probably going to use the capital in better ways, such as small acquisition on the Canadian sides for wealth management from BMO. They just signed that in June of 2025, the acquisition of Burgundy Asset Management. So always looking for a a small way to improve the business, and BMO has been very solid on the wealth management side. So now, and no change for the dividend, but they increased the dividend on Q2, so was not expected to have anything there. So you don't have to worry about it. It's just business as usual on that side. Now let's move on to ScotiaBank. Again, another pretty strong quarter. Numbers are not higher than BMO though, but still solid beat. So revenue up 13.5, earnings per share up 15%. So already you can think, okay, so that makes a little bit more sense. They're pretty much aligned, the revenue and the earnings. So probably we're not going to have like funky details about PCLs or any other accounting stuff, but we have again to deep dive to understand that. So net income by segment, once again, Canada down 2%. So if you remember, for BMO it was down 5%, so it's a little bit better. Actually, the performance was driven by higher revenue and a strong performance on the personal loan side, which I'm not a fan. I mean, it's unsecured loan. It's kind of telling you that Canadians are looking for credit. Not too sure it's a good thing, but short term, it's really good for margin because you get to charge a little bit more on personal loans. Unfortunately, it was more than offset by higher expenses and, you guessed it, higher PCLs. And the way you have to do that is you have to look into not only the press release, but also the investor's presentation so you can get the number and then realize that PCLs, from the top of my memory, was higher, like more than like 5 or 6% for the Canadian segment. And that explains why net income has been down. On the international market, that has been hit and a miss, many times a miss actually for Scotiabank. So a selective narrative, not that much when you think about the results. Well, this time it actually did well. So up 7% for net income on higher revenue and lower PCL. So in this case, it's actually very good because they're doing more money on their loans, but they're also having a lower provision for credit losses. On the wealth management side, we're up 14%. Same story here. Assets under management actually increased by 12%. So you're charging fees on your AUM. Of course, you're making more money. So wealth management up 14%. For capital markets, up 29%. So as I told you before, quite volatile, but when it works, it's an engine of growth. So up 29% on a strong stock market, higher fees. So everything was really strong at that time. And the most important part right now, I believe, is to track the PCLs. So for BMO, it was down by more than 100 million. But as I told you, they had higher PCLs than most banks last year. For Scotiabank, they're actually pretty much flat. So it was 1,052 million to 1,041. So like down 11 million. So it's not moving the needle. It's not changing the ratio. So it's all good. And they kept on buying shares. So on their side, they keep that alive. So I'm putting this online and I'm recording this right before the market opens. It's actually 9 a.m. right now. I guess that the market will welcome those results. I mean, on top of having double-digit growth on both sides, the banks are also did better than expectation. Keep in mind, though, that the stock price for both banks have been going up quite nicely since the beginning of the year. So, of course, do not necessarily expect a big jump, a big movement around banks, but it's actually just good news. If you want to learn how I'm able to summarize this so fast and make it clear, I'm doing a free webinar to show you how to read quarterly earnings, make sense out of it, learn how to dig a little bit further to understand the numbers on September 18th. So you can register at moosemarkets.com/webinar. 100% free. You're going to learn how to analyze the dividend triangle to get better decision, how to understand the quarterly earnings, and make the difference between noise and news. So moosemarkets.com/webinar. The link will be also in the show note. And we're going to talk again on Wednesday, tomorrow, actually, for more stuff. And until then, don't forget to stay invested.